Well, maybe we just jump in. I don't know, kind of with our first one here. I guess maybe it's kind of a pair of cases you kind of teed up. So Holiday and Blum.
Yeah, so like I said, I like your listeners to get more bang for their buck. So in case number one, we're actually going to talk about two cases. I think by the time we're done with it, we'll probably have touched on five or six. I like this case a lot. What better place to start than the very definition of income, right? Like what's included in gross income. But I also like this case because it a lot of the relevant history is in our industry, is in the tax preparation world. So, what happened here in Holiday? You had a taxpayer, a woman who was getting divorced, right? And so she hires a divorce lawyer. Her divorce lawyer takes her through mediation. She's not crazy about going through mediation, but she does it anyway. Mediation does not leave her satisfied, right? So the judge rules, she's not happy with the outcome, and she goes back to her divorce attorney and just says, listen, you left money on the table, right? Like there's this retirement plan my husband's got. I didn't get my piece of that. I got shortchanged about 75,000 bucks. You need to appeal this mediation and get me my 75,000 bucks. So the divorce attorney, files for an appeal, files for a new hearing, I should say. That gets denied. And in his hearing, he does say, like, hey, we got shortchanged 75,000 bucks here, but it gets denied. And he says he's going to appeal, but he just never does, right? So he promises to appeal, he doesn't appeal. So case closed for her. So that's litigation number one that we have to kind of separate in this case. Litigation number two is now she's angry, Damien, right? So she hires another attorney to sue the divorce attorney. And she sues for malpractice. She sues for, breach of fiduciary duty, breach of contract. What she doesn't say anywhere in her suit is like, hey, I got shortchanged 75 grand. You better pay me 75 grand. That's not anywhere to be found, and that's going to be very relevant. Instead, she says, you didn't do well by me. You committed malpractice. I'm suing you. So she ends up settling with the attorneys, and they pay her about 150 grand, maybe a little bit more if I remember. And they say to her, like, listen, we're settling for your claims, no more claims of breach of contract, malpractice, but they're not saying anything about, hey, we're giving you 75 grand to compensate you for what we didn't get you in this, underlying mediation that you say we should have gotten, right? I mean, that was never like proven. It was never established that she got shortchanged the 75,000. It was a contention that she raised, and, it never kind of went through mediation, and the attorneys certainly didn't concede to it. So they said, we're going to pay you about $170,000 to just go away and drop all your claims. Fine. So that's it. That's the fact pattern. It's not overly complicated. It's the precedent that's fascinating, right? It's the law that's fascinating. So she gets a 1099, obviously, for this $175,000 settlement payment. And what do you think, right? She does not include it on her tax return. So the question is, why, and was she correct? So, right, Damon, if we start in the ground floor here, we know that the general principle of the tax law is everything is income unless you can prove it isn't. That's what Section 61 says. Mm-hmm. And, ignoring 61 for a second, we have the 1955 seminal Supreme Court case, Glenshaw Glass, that says, hey, if you have an accession to wealth that's clearly realized and over which you have complete dominion, you've got yourself taxable income. So we would start from a baseline where, hey, if you get a $175,000 settlement payment, are you richer than when you went to bed in the morning? Certainly, or when you woke up in the morning, certainly appears so, right?
Sure, yeah.
Do you have control over it? Yeah, it's in your bank account. Go do what you're going to do. Has it been clearly realized? It has. So we would start from a presumption that, hey, Section 61 in Glenshaw Glass would say you've got income. But we know that there are obviously exceptions to the general rules. And one of them in this settlement arena, I believe we've talked about before, you and I, Section 104.
Mm-hmm. We have.
Yeah, 104 just says, look, if you have a settlement or a judgment that compensates you for personal injury or physical harm, right? The idea is you might be getting a settlement for 200,000 and feel richer, but you're actually just being made whole, right? So if I go across the street and a van skids on some ice and hits me and tears my ACL, and I spend months rehabbing and all of this stuff and, you know, blood, sweat, and tears trying to get back to who I was. If I sue that van driver and get 200 grand, yeah, I might feel richer, but in the eyes of the IRS and Congress, that 200 grand just made me whole, right? It's like if we had basis in our bodies, it'd be like when we got hit by the car, right? We were damaged, and that $200,000 settlement just replenished us. And so instead of picking up income, we would just reduce our basis effectively, right? Now, if we sue somebody and we get punitive damages, that's not excludable under 104 because that's not being made whole. That's punishing somebody for their behavior. Or if we get paid for medical expenses that we previously deducted, that's not excludable either because we already took the deduction. But if we get compensated for being injured, 104 tells us it's excludable. And you and I have gone round and round about, well, what is a personal injury? What's emotional distress? What have you? So we have this concept in the tax law that's codified that sometimes when you get enriched, you're not really getting enriched, you're just being made whole. And that concept exists even in the context of non-personal injury, right? Because sometimes, even if we're not physically hurt, when we sue and recover, we're just being made whole. And I think like the classic example I always use for this when I teach it is it's Rev Ruling 81-152. And you've got a taxpayer who bought a condo, right? And let's say they spent 400 grand on the condo. And then it turns out there's shoddy workmanship and they sue the builder. Well, if you recover 50,000, you're not richer. You spent 400 grand, on a poorly constructed condo. That 50 grand that you recovered is just making you whole. And so we know that even though it's not codified like 104 is, that in some settlements, you are deemed to you're just being made whole, just like in the condo situation, all right? And so in this case with Holliday, right, she said, I'm not picking up this $170,000, whatever it was in settlement income, because I'm being made whole for the payment that my attorneys did not recover from my ex-husband. Now, what she doesn't address is you said that payment was only 75 grand, and here you've got 175 grand, but never let the facts get in the way of a good story. But she's saying, hey, if I had gotten that 75 grand, it would have been tax-free under Section 1041, right? You can transfer property into a divorce tax-free when you split up a marriage. You failed to get me that 75 grand. Now I'm settling with you. That's to make me whole for what you didn't recover from my ex-husband. So that is her premise, kind of like this condo premise that I got hurt. What you're paying me now doesn't make me richer. It simply makes me whole for what I should have got. Okay. So is she right? That's where this awesome case history comes in that impacts our industry. And it goes all the way back to 1939 in a case called Clark. And you talk about simple facts, Damien, right? Tax preparer prepares a return for a husband and wife jointly. But if they had done it separately, it would have saved them $20,000. So the clients go after the tax preparer and say, you made us pay through your mistake an extra 20 grand. We want you to pay us 20 grand. The preparer does it. And the client says, I'm not picking this up in income because it made me whole. And the IRS disagreed, but the courts agreed. The court said, yeah, this was a mistake by a taxpayer. You can show a tax advisor, you can show they harmed you to the tune of $20,000. Like it's easily quantifiable. If you had filed separate, you would have paid 20 grand less than if you filed joint. They didn't do that for you. It was a mistake. When you recover that 20 grand, you're not richer because you paid an extra 20 grand to the IRS. You're just being made whole. Okay. So then fast forward, 75, 80 years to about 5 years ago, a case I wrote about for Forbes at one point, Cosentino. And in the Cosentino case, kind of an extrapolation of what happened in Clark, but with a little twist. Here you had taxpayers who routinely engaged in the time-honored tradition of building wealth by doing 1031 exchanges and holding that property. The plan was until they die, right? And then you pass it on to your heirs at a stepped up fair market value basis and everybody's happy. So they were content to just keep doing that, 1031s, 1031s, 1031s. But a tax advisor came along to them and said, you know, there's a way you can do 1031s and get some cash off the table and not pay tax. And you and I both know if someone's telling you you're going to have cash in your hand and not pay tax, you either got to be really crafty, like the Cubs case we're going to talk about later, or it's a tax shelter. Something's wrong.
Right.
And it turned out this was a well-known tax shelter. And so the client here, ended up having to buck up like $500,000 in additional tax and penalties and interest. And so they went after the advisor. And under the same kind of theory as Clark, the court sided with the taxpayer and said, hey, you were content to go through these tax-free 1031s your whole life. The advisor put you into a shelter, caused you to pay more money. And so when you recover, you're just being made whole. Okay, interesting. But the IRS refused to acquiesce in that case because they said there's this critical distinction between Clark and Cosentino. In Clark, tax advisor screwed up, made a mistake. You should have paid 20 grand less. In Cosentino, this wasn't a mistake. They put you into a transaction that they knew about. You agreed to go into that transaction. The amount you paid was what you should have paid given the transaction that you voluntarily entered into. Was it a tax shelter? Yes. Was it, bad advice? Yes, but you paid the right amount based on the transaction you voluntarily entered into. So the IRS was not happy about that ruling and they refused to acquiesce. And we saw that kind of come home to roost in 2020 in a case called Mckenny. Same thing. Taxpayer got talked into kind of a shelter with ESOPs and an S corp by a very well-known accounting firm, not your firm, not my future firm, but a very well-known firm that all our listeners would certainly recognize. And they had to buck up over $2 million in penalties and interest. And the IRS just kind of said, hey, just like we said in the Cosentino situation here, sorry, this was not a mistake. You voluntarily entered into this transaction and you are paying the right amount based on the transaction you entered into. And here, the IRS actually won. The facts get a little clumsy. The real reason they probably won was more because they couldn't prove that, again, their tax advisor had made any type of mistake. They claimed that they had. They claimed they failed to make an S election timely, blah, 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 but they could not prove it. And so here they lost, right? And so what we start to learn as these cases evolve in the tax industry and how this comes back to our case here with Holliday is what they're really looking at is, what are you alleging in your claim? Can you prove, can you quantify that some mistake cost you to pay more than you otherwise would have, or in this case, to receive less than you otherwise would have, okay? And if we needed one more piece of kind of precedent for the court to settle this case, they didn't have to go back far. As you alluded to, we had a second case in 2021, Blum. And Blum was a very simple fact pattern as well. You had a lady who got injured. She went to the hospital. They put her in a wheelchair, and the wheelchair breaks, and she gets more injured, right? And so I don't understand how they didn't win this, but she hires an attorney. They sue the hospital. They don't win any damages. Now, had they won damages, there's no question they would have been excludable under 104 because of personal injury and physical harm, right? I mean, she got injured. So just like Holliday, now she's mad at her attorney and she hires another attorney, right, to sue her attorney for malpractice. But just like Holliday, nowhere in that suit is she alleging that they caused her physical harm, that they hurt her, that they owe her for her pain and suffering. She's saying, you committed malpractice. You screwed up, right? Breach of fiduciary duty. So she settles and she wins But when she wins, she excludes the income because she says it's replacing what would have been tax-free under 104. And the courts just say, hey, I get it. But what we've learned in Clark and Cosentino and other cases is we have to look at your specific claim. And not only did you not claim that your attorney physically harmed you, the settlement agreement language actually says right there, we are not paying you for any physical injury. We did not injure you in any way. And so I know it seems unfair, right? If they had recovered, you would have excluded it under 104, but whatever they're paying you because they didn't physically hurt you, it's not excludable. I'm sorry, you lose. So then you take that concept back to Holliday after that long digression we just went on, Damien, but bring it all back to Holliday, and they look at her claim against her attorneys for malpractice. And again, what it says is, you screwed up by not filing appeal, right? You didn't serve me well. It doesn't say anything about I was owed 75 grand. You didn't get it for me. Now you owe me 75 grand. And the settlement agreement didn't say we're paying you 75 grand to compensate you for the 75 grand we failed to get you. And so the court concluded, hey, very sorry here, but unlike Clark, right? Unlike Rev Ruling 81-152, you can't show, you haven't established, you may be claiming, but you can't establish that you were harmed to the tune of 75 grand and that they're just paying you back for that, right? I mean, you're alleging that you were shortchanged 75 grand, but no one ever concluded that that was the case. And so you're richer, right? You haven't showed you were harmed, so you're richer and you got to pick up the whole amount as taxable income.
Yeah, I mean, it's just interesting, right? I mean, something seemingly simple and straightforward clearly is not, because there's so much involved, and it's facts and circumstances. But what I'm kind of hearing you saying is those facts and circumstances actually have to kind of be in the plain language of the settlement agreement for you to be able to get there, even if it's once removed. It's perhaps even more important, right? Because I mean, both of those are sort of once removed.
They are
situations,
both once
you know.
removed. But even when we talked about 104, the settlement agreements are critical. Absolutely critical. And if you don't have a tax savvy person looking over them, even when someone has clearly been physically injured, you can screw up and end up, with payments that are allocated to emotional distress or punitive damages, and then you're picking up income. And so, yeah, it is. And again, I think why I liked including Holliday and Blum is we do get that digression into our own industry and the notion that we can harm somebody by making a mistake. And I just always find it fascinating that when you get a fairly straightforward set of facts like this, we're talking about cases from 1939. I mean, that's how the law is built, right, on the relevant precedent. And it can be a seemingly, like you said, innocuous set of facts, and we're citing case law from darn near a century ago. And I just love that aspect of the case law, that it's built on, this foundation and these layers that never disappear unless they get overturned.
Right. It's kind of just the story just sort of evolves, and like you say, even if it gets overturned, that's sort of just another layer in terms of it sort of adds another like branch to the tree or something. I don't know what the right metaphor would be. I'm trying to come up with a good metaphor here, Tony.
The best way I can explain it, Damien, is I love when I teach grad tax. And I love when we start the semester learning some of the seminal cases, the Eisner-Comers and the Glenshaw Glasses and the Grotzingers. And then I love as the semester goes on and they just read more and more cases that cite those cases, and then they start to recognize all these cases being cited and they're like, oh, okay, like this all ties together in some magical way.